Hello, everyone. Welcome to the FTX podcast. Really happy to have here with me today, Suju. Welcome, man.
Hey, Tristan, thanks for having me.
Yeah, it's my pleasure. Would you mind introducing yourself to the listeners to start off here?
Sure. So, based in Singapore, run a crypto hedge fund called Three Arrows Capital. We trade large caps, mid caps, also do a lot of primary investments these days as well. Um, kind of from both short-term to long-term trading, and also a client of FTX as well. We trade pretty actively on the exchange. So.
Awesome. And to go back a little bit in time, I'd really love to know how you got into cryptocurrency initially and how your journey started down that path.
Sure. I guess 2013, late 2012 or so, started hearing about Bitcoin and found it interesting. People were using it to move money around. I was in Hong Kong at the time, also in Macau, and kind of got interested in just the way that it could be used as cross-border movement. I think the arbitrage opportunities then were also starting to get interesting, but not too scalable yet. You could, buy it in Bitstamp, sell it in BTC China, and do that kind of trade. At that time, concurrently, I had been starting Three Arrows, which was at that time mainly focused on emerging market currencies. So kind of ended up focusing more on that, and crypto started doing less of just because it was not very scalable. And then kind of picked it back up once we kind of saw it redeveloping into a real market after the bear market ended. I think that, thinking back to that time, it was quite a deregulated time compared to even now, right? Because you even had in China spot exchanges. You could deposit fiat from a bank, China Construction Bank, straight into an exchange. Whereas, 7 years later, you still can't do that. So I think in some ways, the whole space has developed quite different to what I would have imagined back then, but it's definitely exciting space.
Yeah, I mean, it must have been quite a journey seeing this growth. I don't know if you know Zane Tackett, but I had a conversation with him where he was saying that, back in 2014 or something, they couldn't move 100 million in like a month or a few weeks or something. And now you can do that in a day across all the exchanges if you want to move money like that. So it's pretty impressive where the space is going. And if you don't mind, I want to take you even a little bit more back in time and ask you how your path went down the financial routes and like why that's what you chose and what called you there.
Sure, that's a good question. No one's really asked me that. So I majored in math at Columbia. At that time, I wanted to go into academia, but I did an internship at investment bank. It was my sophomore year, and I didn't really know what I wanted to do that summer. But I had a friend in the class who said, if you go intern at investment bank, then they'll pay you $10K for the summer, and they'll also let you you can travel a bit. You can kind of get to see some things. So, I mean, that was compelling for me because I hadn't really traveled too much on my own before, and I thought the pay was decent. So I kind of just went into it blind. So they had me like half in Tokyo, half in Hong Kong at Credit Suisse. And at that point, like my boss in Tokyo really liked me, and he said, "Why don't you join full time? But I don't want to wait like 2 years, so I want you to like graduate early." And so I ended up taking him up on that. And then that was in late, so I joined officially in late 2008. And then he had to lay off the whole team about 4 months after I joined because of the financial crisis. But the whole book blew up. It was equity derivatives trading. But I was really fortunate then. So at that time I was like, okay, so do I go back to the States and, or go somewhere else and try to find a different path? But I managed to get a junior trader job at Flow Traders in Singapore. Mm-hmm. This was in early 2009. They had just had a very good year in 2008 doing ETF arbitrage. And they were opening a Singapore office. And so they just needed people to show up there. So they had only 4 people at that time. So I think there's where I actually learned a lot of what I know now, which is, market neutral trading, directional trading, special opportunities, special situations type trading. So I think really fortunate that that time Flow gave me a chance to work for them. I did a couple years there, and then moved to Hong Kong, worked at an investment bank prop trading group for about a year. And then at that point, decided to start my own firm with my partner, Kyle.
Sweet. So it's Kyle and you who founded Three Arrows Capital then?
Right, that's right. Yeah. And he had worked entirely at banks, doing similar type roles, but yeah.
And was that shift? I mean, I can imagine the shift from FX markets to the cryptocurrency world. Was it big, or was it just at the end of the day just numbers and you could kind of quantify it in the same way? Were you comfortable right away?
It's quite different, I think. I mean, I would say in FX we so there are some similarities and differences. I would say our strategies in FX were much more focused on the market structure in terms of there was a multi-dealer market in FX and a multi-venue market. So you had OTC versus listed. You also had, top tier banks versus second tier banks versus third tier banks. And so one of the reasons why we started Three Arrows in 2012 was because we were while we were at prop desk, we realized that there was a lot of ways that people were mispricing liquidity, or they were miscalculating how liquidity should be redistributed. And what I mean by that is there are a few trends that were really in our favor back then. Like one trend was the fact that all the EM desks, they wanted to move from voice to screen. So they wanted to create single bank platforms like this, this login, this GUI that you could just click and then show prices. And then next to that, you also had people who wanted to, second, third tier banks that wanted to not just be a taker from the top banks, but wanted to quote their own clients directly and internalize risk. So that just meant that there was a lot of people trying to quote that didn't really know how to quote at that time, and a lot of people that were also trying to do a lot of volume that didn't really understand how to do it. So we kind of recognized that that's actually a very good market to be a taker in, because you can access liquidity at a price that's mispriced fundamentally. So I would say like our strategies in FX were like 95% taker strategies, where we're just buying the offer, but we try to buy the offer as big as possible because that kind of liquidity gap creates the momentum that you need to make money, basically. So that kind of structure, eventually, banks started to figure out that, it's very hard to quote that way and make money. It's very hard to do this and make money. But I think that going to crypto, I think it's very different, because in crypto, most people they're trading their own money. They're not trading other people's money, right? So what that means is that people are usually a lot more careful about what they do in terms of, if they have a strategy that's losing money, they can't just warehouse it and put it on some weird balance sheet that no one knows about. Usually, right? They kind of, it's a lot more, people keep tabs. So I think there's, but on the other side of that, there's a lot more access to overall flow. So there's a lot more information that's out there. Whereas in FX, that information would sit at a top tier investment bank's desk. In crypto, you can kind of see that signature flow through the market across a number of venues. So I kind of think that it's a much more level playing field in crypto in that sense. So for us, we have to work harder at figuring out what's going on. But on the other hand, there is not this kind of tiering where you have investment banks that have a huge percentage of the flow and they kind of can move everything. So.
And from when you guys started in crypto to now, I mean, I can imagine, but I'd like to know a little bit about, so, you had this taker strategy in FX. When you started in the crypto markets, kind of what was the strategy you sort of developed, and has that transformed a lot over time, or have you been able to kind of just keep building on what you had initially?
I think for us, we've always been relatively opportunistic. I think initially we started off just doing basic stuff, right? We were buying spots, selling swaps, buying spots, selling futures, kind of basis art, basis trading, and also doing sort of more just rebalancing between Bitcoin, Ether, dollars, and kind of capturing a lot of alpha that way. And I think over time we started to be able to have more discretionary models on top, where we can kind of identify, like, there's always the signature in crypto, right? There's the effects of where it'll go up into a mainnet and then dump into the mainnet, or it'll go up into the airdrop and then dump after the airdrop. And so these kinds of things are good, but it's just about how do you access that, capital? How do you access that trade? How do you kind of put it into action, right? So, I mean, a good example of this was probably Tron, right? In early 2019, I want to say, where they had just announced like the BitTorrent airdrop, and then proceeded to go 5x, and the backwardation was insane. People were trying to borrow it everywhere. I mean, we had done some good trades where we had locked in borrow Tron. These kinds of things. I think. I mean, our general style is to be as nimble as possible, and we from since 2014 we've traded only our own money. So we, generally speaking, try to be as unconstrained as possible in a mentality where we're taking direct principal risk. So that means that we also want to be able to make decisions that other people might not be able to make very quickly, where we can say, this is a good opportunity, this is a good trade, and just be able to do it. So I think that kind of flexibility has helped us a lot over the years. And as our balance sheet has grown, it's kind of been a situation where we realize that the capacity of the market is not there for us to just do that trade only. We have all this excess capital now sitting around, so we do some other trades. We do grayscale trades. We do core investing into layer one, core investing into application layer. So I think for us, it's just about, it's like family office almost, right? It's like how do we invest our own money in a sort of Kelly criterion way? How do we maximize our expected value given opportunity sets that we see? So
Yeah, and then that makes a lot of sense to me. But I kind of want to ask you a little deeper on the fact that since it is your own money, as you said, you're not just having other people's money in your balance sheet. How do you weigh like EV versus risk, knowing it's like your capital? Is that like scary, or how does that work?
that's an interesting. I think in some ways it's less scary because with other people's money, you have to also consider reputationally what is the right trade to do. But when it comes to risk, it's a lot easier to define risk in terms of this trade, this capital is allocated this way for this trade. So like we basically silo off our market neutral trading with our other types of trading. And for market neutral trading, it's very bread and butter, but we did that in a very disciplined way. And so, during the March crash, we did very well compared to most firms, just because of the fact that, we're recognizing. I think we recognize that market structure risk can often be bigger than directional risk. Where if you have like a long short spread trade on two venues, you're making a bet that the one that you're long on won't liquidate you in a weird way, or that they won't, tick in a certain way. So I think, because we've seen a lot of weird stuff in FX over the years too, with the Swiss franc move in 2015, where brokers repapered thousands of trades with clients and mid-you, all these kinds of things. I think from that experience, we recognize that the type of things that can go wrong are not just about price; they're also about market function, so market structure. So we try to hedge those risks and be more aware of those. I think being a principal helps us see those risks. And so it makes us more comfortable with directional risk, which I think is plus EV, and also makes us more aware of structural risk, which I think gives us an edge usually.
And this is, sorry, an ignorant question. What does it mean the brokers repapered?
So Swiss franc was pegged to the euro at 1.2, or rather floored at 1.2 for about several years. And then in January 2015, the Swiss National Bank suddenly announced that there is no peg anymore. There is no floor. So Euro Swiss at that time was a very popular retail trade. You would go long at 1.2, sell it at 1.21, or sell it at 1.2055, and you'd like scalp that range. Like they called it grid trading. Basically, like they trade that very narrow range and they scalp it, right, on huge leverage. So every retail FX broker's book was very long Euro Swiss. So when that happened, immediately the market, the interbank market disappeared because people just pulled all their bids from the market, right? And there already weren't that many bids there, because if a currency is pegged at 1.2, why would you ever bid 1.19, right? You're never going to get filled unless you're completely fucked. Like the only way you get filled is if there's a weird, right? So there's no liquidity from 1 to 1.2. So and as a result, the market just nuked down, and a lot of the retail brokers' systems, they couldn't handle this kind of flow because their clients were getting stop loss. Some clients were on 50x leverage, so you have to stop them out at 1.18 or something, but you can't because there's no liquidity to hedge into. And a lot of bank systems malfunctioned. So I mean, there's still ongoing lawsuits today, 5 years later, between some of these brokers and these investment banks, where they're saying, was the trade at 1.14 a real trade or not on that day? because the system was not prepared for it. The whole repapering mechanism of FX was based on the idea of that was deregulated, that people could, like, reasonable people could come to terms, and that worked until it didn't. Where this kind of stuff, that there was huge losses. I think top 5 dealers on average lost 9 figures. There was one of the banks that basically internalized the entire market and ended up making like over $1 billion because they bought up everyone, knowing that eventually it would be traced back. Because the lowest it went was 0.88 that day. And they kind of just bought up everyone. They were at some point down $1 billion, up $1 billion. So, there's also a good show of like how if you're the only guy who can take risk at that point in the room, you can still make money. You can make quite a bit of money. But yeah, I think from those kind of experiences, we recognize that sometimes, you what do you do if you can't log in for 6 hours, for instance? Like, are you going to be okay if you can't log in for 6 hours? So I think, despite all the crazy stuff that happens in crypto, I think in FX, like, I've actually seen crazier stuff.
That's pretty wild to hear, actually, because I mean, just from like what you learn in school and stuff, FX is this traditional boring market, yada yada yada. So it's really cool to hear like more of the insider perspective there. So I appreciate that. And when you say, does it come down to exchanges for you? Like, that's where the risk is, the fact that you have to go through these basically brokers that allow you access to the markets?
You're talking about now in FX or in crypto?
Oh, no, sorry. Like, back to crypto. So you were saying in some ways market structure wasn't as scary to you as some of these other mechanisms. And I was asking, is that in some ways these exchanges then that you have to go through?
Yeah, I think, for us, we prefer to only trade on top tier exchanges for derivatives. So, BitMEX, Deribit, FTX, these kinds of venues. And then for spot, we are generally quite conservative as well in where we trade and where we will sort of execute through, just in terms of being able to have a low signature in the market and have a low kind of footprint, I guess, if you will. So I think fragmentation is something that we're very familiar with, and we kind of operate well in a fragmented environment where people don't know where the flow is coming from. We can execute in a wide range of venues simultaneously. So.
Cool. And I guess my lead up question to that was, does a platform like Serum, for example, change that in some ways? Like the fact that now it's just purely protocol decentralized and that you can kind of expect what's going to happen. If it really takes off, does that change your perspective here? Or like, I'd love to hear what you think about these decentralized exchanges if they could get to a centralized exchange level.
So Serum's approach, I think, is very interesting, namely because I think Solana, if it can deliver the throughput needed to have a protocol level DEX, then I think that can be a pretty big pie, because people don't have to, they don't have to KYC, they can just trade from a web wallet. But I don't really see it as eating up centralized exchanges completely, just because there's a lot of other things you may not want to have on a blockchain. The user may want their funds in an account that's just like you can log in or whatever with 2FA, and you can kind of have that safe experience. I mean, I think there's ultimately a lot of benefits to having centralized exchanges conceal flow, right? I mean, you see in Ethereum right now, like, everyone is doxxed, all the whales are doxxed, like, all the movements are doxxed. So it's kind of, unless you have privacy on that layer, you're not going to want to. If you're a whale, you don't want to be trading spot on a DEX where that's very doxed. But if there's ways to conceal that, if there's ways to offer more privacy, then I do think that is very powerful. Ultimately, I think the whole DEX, the protocol level DEX space is very hard to predict now the way it will grow. I think that like obviously Serum has a good shot because it has FTX expertise behind it. I think some of the other ones have good shots as well. I think ultimately, as long as you can bridge to where the assets are, then there will be demand to use it. And I think as long as you bridge to, and you make it relatively usable for people. So I think where Serum would have an edge is that the gas, the transaction costs are very low, and the deposit withdrawal is very cheap as well. Whereas for a lot of the stuff that's built on Ethereum right now, that's not using layer 2, that's not using the stuff. You pay $100 to deposit, you have $1,000, you already lost 10%. It's not a good experience. And I think that they know that too. And I think the difference between then and now is that now, with Polkadot as well, with Near Protocol, with these other sidechain or like other chain solutions, hopefully that'll push Ethereum to also give a better user experience, right? Where it's not just talking about layer 2, it's actually delivering it and using it so that people can actually achieve adoption as opposed to just whale games. So.
No, I mean, it's pretty well that it has been 3 years and everything. And actually, I thought that was really interesting, and it does make sense. I hadn't heard that take before, where actually being on a centralized exchange does in some ways guarantee your privacy more than trading on the blockchain. It's like, it seems like counterintuitive, but it makes a lot of sense.
Yeah,
So,
I mean, especially the big ones. I mean, Coinbase is often used as a mixer for people, right? Where if they want to send to someone, they'll deposit their ETH into Coinbase, then send it back out, because that's way better than linking the two addresses. So.
mm-hmm. Yeah. Oh, yeah, you give me a lot to think about there. And I guess to kind of bring it back to what's going on right now, like, what are your thoughts, and kind of maybe if you could walk me through a little bit, could we do a little recap of kind of like how your thought process has evolved since Compound released their yield incentives to where we are now?
You mean just general thoughts on yield farming and DeFi in general?
Yeah, and like in kind of, it started with Compound. These guys who have been working on it for 2.5, 3 years almost, like, they're serious, everything. And now we have like every vegetable farm under the sun. I'd love to hear, your longtime trader's perspective on this.
I think initially it's a good idea fundamentally to distribute tokens to users, because they're the ones that are going to be able to ultimately improve how the protocol works and give you the right feedback, and also have a long-term ownership stake in it. But the problem always is that with incentives, there's always going to be like industrial scale farming, or there's going to be sort of short-term farming. And that's actually unavoidable, but I think it's still better than if you were to give these distributions directly to people that invested a long time ago, for instance, in the company itself. So I think it's not perfect, but it's a step in the right direction, I think. But I do think that governance tokens in general, people need to think very hard about what does it look like 6 months down the line or a year down the line, not just like a week down the line. And right now, I think there's a very short-term focused element to the market where they're like, okay, this is the next fruit, or this is the next vegetable, and we're going to farm it this way. And so you need to buy that asset to farm it. And so everyone will do that. So you buy that. It's a little bit like 2017, late stages, where people know that it's just a money game, or it's just I won't use the word Ponzi because I think it's loaded, but it's a game of memetics, right? It's a game of what is next, because what is the next meme? What is the next fashion? And the reality is that game ends very quickly if just a few whales dump, because it's like it goes up very fast, but it only takes 10% of the supply to even think about selling for it to go down like percent. It was like 70%, right? And so I think there's a lot of fundamentals that are lacking in some of the latest stuff that's coming out. I think with stuff like Wi-Fi, with stuff that was a proper launch with a long-term roadmap, I think that's great. And I think, the debate is still out as to which ones of the ones currently that have launched will have that community, will have that, vision for how it will evolve. So I think, sushi is an interesting one, because, FTX is also pretty involved in that. I think it's a good idea intrinsically, but obviously you have to figure out what the roadmap is as well, right? And it's a competitive space. So I think, it'll be tough to say today, like, which are the ones that will be around in a year or 6 months. But there's some that are pretty clear that, the founders really have no aim of making it last, right? Like, do you see the cycles are getting shorter and shorter now, where, hot dog comes out and then it nukes in like a day, or like,
Kimchi.
I think it was SYFI, where upon the rebase, like the exact moment of the rebase, the guy also nukes the coin into the pool.
Yeah, I saw that.
So it's the cycle's getting shorter because the scammers also recognize that, like, hey, like, this is not going to last that much longer. But hopefully it's a healthy reset. I think it kind of resets people back into saying, okay, how does this actually accrue value? Can we actually build something that is longstanding? And you can't keep forking everything, right? You have to at some point say, this is what we use for this AMM and the distribution. We like it because of this. Because the thing with like forking repeatedly and the liquidity washing back and forth is that ultimately it doesn't accomplish that much. It's not achieving anything. It's just creating a money game. And the people that win that money game, they may not ultimately, support new games. They may just cash out of the system. And then you end up having like an ICO situation again, where ultimately a few people win a lot of money and they take it out of the system and then the whole game nukes, right? So you don't want that to happen where it becomes a poker game as opposed to building something non-zero sum.
Do you think that kind of happened in the last 24 hours? Because I was kind of been watching, this dump, and I was really curious because I know there's been a lot of wealth generated over the last maybe like few months now, but really intensely over the last few weeks. And now to have such a strong dump, is it that in some sense you think like some of these whales were said, okay, you know what, time to take some off the table or something? Because I would have thought maybe like all this farming money would have gone into other maybe stronger projects, but I was surprised a little bit.
Yeah, that's a good question. Speaking to some people, they're long-term bullish, but it's ultimately like where are we in the latest hype cycle of DeFi farming? And I think if we're not near the top, or just come off the top, it's definitely not the beginning, in my opinion, because the beginning is marked by not people having not made money yet, and people not really knowing about it. Whereas now you're in the phase where people have seen the Wi-Fi wealth creation, they've seen like this other wealth creation, and they kind of want a piece of it, but the fundamentals to back it up are not there for the new ideas. So you kind of end up with you kind of end up with the situation where there's a lot of desire to make money, but not a whole lot of ways to make money. So as long as everyone believes that this coin is worth X, then everyone's APR is high. But the moment people realize that you still need a guy to buy that coin for everyone's APR to be that number, then the mirage shrinks. The mirage, it breaks instantly. And once it's broken, it doesn't come back, in my opinion. It's just once, it's like in late 2017, early 18, all the ICOs were like, well, you can't dump your ETH because that's how you lose money. Like Augur dumped their ETH too low at $5, and then so everyone held their ETH. But then as soon as they realized that not everyone is holding their ETH, they're like, fuck, okay, now we got to dump our ETH to Bitcoin or to dump it to dollars. So it's as soon as the mirage breaks, then that belief that you can hold that coin and still make money in a month, once that's gone, then you just have this cycle. But I think that's honestly healthy, because it means that people will be a little more skeptical of the new farming thing that comes out each time. And
Yeah.
people will then see what's already been built and then say, okay, how do we actually contribute to this? Let's say Sushi succeeds and they become Uni V2 for a while. People should then build on that, right? People should actually contribute to it, come up with something to make it more useful. They should absolutely not fork it again and then make a new one just so that they can farm another thing. The goal of farming is not farming itself. It's to achieve a distribution that's incentivized to improve the protocol and distribute ownership. It is not farming for farming's sake. And I think at least the past few days, it has become farming for farming's sake, where it's all about how do you show people really high APR and then rug pull. How do you make it as bizarre as possible, that kind of stuff.
Yeah, no, I totally agree. I mean, and I think another part of it is I really like your mirage analogy, and I also really like it because some of those mirages will turn out to actually be oases, and will last the test of time. And I've actually been really curious because I've been interviewing some of the founders of these projects, and I think I have a sense of which ones are going to stand the test of time. I think Wi-Fi, even if these incentives come way down, the 10% stablecoin APR is still going to exist. That can maintain itself. People will still want that. It's better than most traditional investments. I think Lend, what they've built, is already at a very sustainable level. It's Stanny. I have a lot of respect for Stanny because that guy just, I remember ETH Lend back in 2017. It was a total shit coin. There was no functionality. I owned the coin, and the fact that they just kind of sat down for the 2 years of bear market or whatever and worked, it kind of really shows. I did fail the IQ test. I mean, I interviewed Andre when Wi-Fi was like $400 or something, and I felt the man's intelligence, and I didn't like go see what the tokenomics of his coin was, and that was not a good call. So I thank you for that analogy. I think it's really good. And so if the mirage bursts, does it fully burst for everything, or do you think it bursts just for this farming stuff going on right now?
I think it just bursts for segments of the market, and it probably makes people then question the value of governance a bit more. Like, I think people will then have to prove that their governance has value as opposed to just assume it has value. Because right now, like, people are assuming that governance has value. Hence, if there's X amount farmed, then there should be X amount of dollars, in the coin that's being farmed, which is it's obviously like an obscene concept, right? Where, because the money that's farmed is not necessarily risk, right? It's also not necessarily stable there. So I think a lot of these kinds of valuation memes will get under attack over time, and it doesn't even take like a big crash. It just takes, if numbers don't go up anymore, then people will say, okay, what will happen? Especially if, like, let's say, layer one start going up. Let's say Bitcoin, Ether, Polkadot, Solana. Let's say layer one start going up, and then DeFi coins stay flat. Then people will also be asking, do these memes not hold anymore? This like total value locked. So I think that the market needs better metrics for sure. But I agree with you also that even if most turn out to be mirages, there's definitely a lot of true innovation that has happened, and we're long-term very bullish on DeFi. It's just a matter of, I think, the market clearly got ahead of itself, and was starting to get very greedy, I think, into a lot of these moves. And I think like the scammers are out in full force, right? Like they're, a lot of them are trying to figure out, how do we deploy as fast as possible? And I think that, so if it's like spring 2017, then we'll be talking about this now, but then it won't matter because they'll do it anyway, and they'll, it will end up still growing through it, and the mirages will actually grow big, and some of them will even end up going legit in the end. But I think right now at this point, I'm still mixed on how that will develop. I can see it both ways.
Cool. That's good to hear. And then, so you've been through more cycles than most. And are you seeing less mirages and more innovation, or like what's your sense of the cryptocurrency market overall at the moment? Just and I'm not saying it from a price action standpoint. I think I'm saying more from adoption usability standpoint.
Yeah, I think there's definitely way less mirages than before. A lot of key myths in 2017 about scalability and about what blockchain is useful for, I think those myths have been debunked fairly well now. And so people don't really buy into hype in the same way that they used to. And, like even with DeFi, right, at least it has a mainnet, at least you can interact with it and see how it works, right? Like the code has to actually work. But in 2017, like stuff didn't even have to work. You just had to pay a guy to have a white paper and then pay a consultant to get it, like listed somewhere. And, and also I think even the coin distributions, right? Like back in 2017, you'd have an ICO where they claimed they did a crowd sale, but one guy just bought all the coins like from the crowd sale. And then he's like, okay, this is like 1,000 addresses, but it's just all him. Mm-hmm. And then you can make it up, go 100x. And then it's like, even if he sells 1% of what he has, then he's made free money. Like these kinds of games of 2017, they don't really happen anymore because users are a little bit smarter, and there's at least more on-chain forensics going on. Like when coins move on-chain, everyone's talking about it. I think the IQ level has gone up a lot compared to back then.
Speaking of on-chain metrics, I don't know if you've seen the crypto quant guys. They're actually doing some pretty cool work. The reason I mentioned that was because I think like a day and a half ago, right before the market kind of had this latest little dump, their CEO posted a picture of the miner outflows, and it was kind of like, hey, I think something's happening here, and he called it very, very, very
just
perfect.
Give me 1 second.
Yeah. Yeah, for sure. No problem. And we're back. All right, man, I just have a couple more questions for you. I won't take too much more of your time, but one of those questions is, if you're speaking to people that may be entering the cryptocurrency market for the first time or are new, what are some words of advice that can help them be in for the long run rather than the short run?
I think a good rule of thumb is to generally have a portfolio plan, meaning that you kind of have a thesis for why you're joining the space. If you're bullish on Bitcoin long term, if you're bullish on Ether long term, have some kind of fixed allocations that you believe in, and then be willing to make or lose money based on those, right? So don't just take all your capital and chase the newest fad. Make sure you do have some long term holdings as well. And then for whatever you trade that's more short term, make sure that you have a way to kind of grade yourself on whether you're right or wrong. Sort of falsifiability is one of the most important things in trading, right? Where you're able to falsify whether you are good or bad at something, or whether you have made the right or wrong choice. So I think having that kind of segmentation is key, and then having that discipline to say, like the joke always is that like everyone is a trader until they're down on the position, then they're an investor, right? So don't become an investor in things that you're originally trying to be a trader in. Everyone's made that mistake, and that's probably the biggest key to avoiding, big impairing losses, which are hard to come back from. And at the same time, if you're good at something, don't be afraid to do it bigger and to try to figure out if you can scale it up. There's a lot of opportunities in crypto, so it's important to also take advantage of them while they are there, because the markets change very quickly and it moves to the next thing. So if you're good at farming, or if you're good at trading DeFi coins, make sure you maximize what you can. And if you're good at leverage trading of alts, make sure you also size it well when you know that you're right, when you know that there's a high chance that you're right. I think another mistake people make is they size all their bets the same, or they start sizing their worst bets bigger just because they want to double down so that they get back to flat, or they want to do these kinds of things, right? And oftentimes people don't size big enough when they're the most right. They start taking profits off when it starts going in their favor like a bit, or if it comes back to break even, they start taking off. I think all that kind of stuff, it's just all psychological, right? And always being aware of what your conviction level is on any trade is very important. Being able to quantify that. So
Cool. You heard that, listeners. And then I think this next question overlaps with that a little bit, but it goes more to you as a entrepreneur and as a founder rather than as a trader. And it's something I'd like doing is kind of asking founders what some words or lessons that you've learned throughout this path that could help people also build their own things or kind of start an entrepreneurial journey in some way.
I think there's a few things that I've learned over the years. One is that there's always opportunities. So don't be afraid to pivot necessarily. Don't be afraid to be open-minded and hear what people have to say. I think there's a lot of entrepreneurs that are scared of alpha leakage or people copying their idea. Don't be afraid of that, because they're just as likely to give you your best idea as you are to them. So I think not being afraid of that, but just being confident in your own ability to execute, and having that kind of non-zero sum thinking is one of the most important things as an entrepreneur. You have to be able to attract talent. You have to be able to be confident in your own talent to execute in a competitive world. And that ultimately is, I think, the most important part, because I think in trading, some things are more zero sum and you have to be more secretive. But when you're an entrepreneur, you have to convert people to your vision. You have to convert people to what you're doing. So
Cool. Thank you. Thank you. Thanks for coming on the podcast. I know you're a really busy guy, so I appreciate your time.
thanks for having me, Tristan. A lot of fun.
Yes.